Hi everyone, my name is Lerato Skansie, your investment and financial advisor. I welcome you again to another fun-filled and information-packed episode on the Strategica channel. Do remember that this channel is dedicated to giving you guys a financial knowledge that you need to implement in your everyday life and improve your financial situations. The information story that we share does not constitute as financial advice, but if you do need professional help, do contact us and we will assist you. In last week's video, we're actually talking about how to save for your child's future. So we discussed a few options. I think we discussed 4 of them, and one of them was actually insurance policies and investing for your child's future. So today we're going to discuss in particular investing, which is a pure investment account that you have, versus having an insurance policy or an educator policy for saving for your child's future. So the reason why I wanted to have this video is because we have gotten a lot of people who are actually conflicted as to whether they should be having pure investments or should be holding insurance policies or your educator policies. So today we're going to actually be discussing the different advantages of an educator policy versus that pure investment, and then we'll also have a bonus video where we'll actually be looking at the numbers as to which one makes more financial sense for you. We will start by discussing the pros and cons and the different advantages and disadvantages of an educator policy or an education policy. So like the name suggests, it is a policy that is run by an insurance company. Given that there's been different developments in the insurance industry itself, there are different options that are out there for you. But what an educator policy does, or is in generally speaking, is a policy that you take out as a parent on behalf of your child who is still a minor. So the main reason why you take out this policy is so that in return for the monthly premiums that you are paying over to the insurer, at a certain point in time, the insurer will be giving you back lump sums of money that you can use towards paying for your child's education. So you might find that there are different options out there. There are different starting pay points. There's somewhere you can start taking out a loan on that particular investment that you have been accumulating as you're paying the premiums over to the insurer. So we'll be talking about those shortly. So how it works is every single month as the guardian or parent, you're paying over the monthly premium. So there is a contractual agreement that will actually now specify how this policy actually works. So it will specify things like what is your monthly premium, if there are any annual escalations or increases in the monthly premium that you'll be paying on an annual basis. There will be the maturity of the policy. If it does have a maturity date, it will specify other things like when it will start paying out. So let's say, for instance, you take it out when your child is still 2. Some start paying from when they start primary, then high school and varsity. Then you also have other options where there are some that allow you as the premium payer to the account or the owner of the policy, as it's taken out in the name of the minor, to actually access funds. So this is where now you're able to take funds and borrow from the policy and so on and so forth. Some also have a disability portion or benefit that is the disability portion that is also embedded in the policy. Some have a waiver benefit in case as the premium payer you are unable to pay for a couple of months, then they actually don't lapse the policy, Then there's other special conditions, that are specified in the fine print that actually needs you to actually have a very good look at them and make sure that you understand what the policy says. So to get to the advantages and the different disadvantages, so like we said that the advantage of having this particular education policy with an insurer is that you can have other insurance benefits that are also embedded in that particular policy. Over and above paying for your child's education, there might be critical illness, or you might have the premium waivers, like I was saying, which are an advantage, because if I were to fall ill and I'm unable to make some certain premium payments for a number of months, you might find that the policy would not lapse and it will still continue as if nothing has happened. So that is a huge advantage for the premium player, so that if ever there are times where you get retrenched or there's a little bit of critical illness that is embedded, or when the premium player actually passes on and you find that there are other options where for a certain number of months the premiums will be paid for without any impact on the actual policy itself. So then the other one is that the fact that it is actually predetermined, there are debit orders that can be put in place. It actually makes the premium player diligent in terms of paying that premium on a monthly basis. So the debit order that comes off, some people actually have it as a stop order that actually deducts directly from their salary. So when you get your salary, it's actually already net off that your monthly premium that you need to pay. So that is actually good from a budgeting perspective, where you're able to now say, okay, I need to put this much away, and it's going to come off your salary straight away. And then we've said it also helps you in terms of being consistent, and the fact that it is an insurance policy, you might find that some of them when the premium payer passes on, whatever you had contributed towards that fund might also just stay in the fund up until when the child can access the money at any future specified date. So the disadvantages, so like any other insurance policy, there might be the fine print. So having to go through that fine print, I know most people don't like doing that, so that could be a disadvantage, that you actually don't understand the financial jargon that has been listed in the fine print, and you actually don't understand how this policy actually works. There might still be that risk of the policy lapsing. And what we're saying is that since it's insurance and you're only covered when you're paying your premiums, failure to actually pay your premiums means that you will forfeit the benefits on your policy. And forfeiting the benefits means even if you had been paying for the past 5 years and then you stop paying at some point in time, all those premiums that you have paid for those past 5 years might just go to waste. So please make sure that you read the fine print and you know what it says in terms of the periods you are allowed to miss your number of monthly premiums, when then does it become an issue, and what is it that you have to do to recover. And then the other one that we want to do is that there might be penalties that you might face as you are as you are missing these premiums, and if you want to withdraw actually from that particular policy. The penalties come in a form of you now saying, let's say for instance it is a 5-year term policy, and then you need the funds before the 5-year term is over, then you'd find those penalties. Also, I had mentioned, which is actually an advantage as well, the fact that you can actually draw a loan from the policy itself is an advantage. But it also becomes a disadvantage whereby you, as the premium player, do not replace the money that you've taken away. Like I'm saying, it is a loan and it is thought that you are actually going to be able to pay this back. Taking out the funds from the policy hurts the investment that you are actually trying to put away for your child. So we also need to be wary of that fact that if we do take out the loan, we do return it, and the time that the loan is out of the market, it means that that money, the potential interest that it could be earning, it's not earning anything at that point in time. And so like I said, the other disadvantage could be you don't necessarily have the choice as to the underlying investment that underlies that particular policy fund. The choice must be done by the insurer, and you don't actually have that liberty to choose where the investment is placed. So some important tips quickly before we move on is that, one, make sure that you read the fine print. I can never stress this enough. I know it's a couple of pages, the print is very thin, but you need to read that so that you make sure that you understand the policy and you understand what you're taking out. And most of us, get approached by the agents, and the agents sort of like, do it quite quickly. They're under pressure, and they want to get that commission going. So sometimes they do not explain some of the nitty-gritties of the policy contract. So when you do receive it, please make sure that you read the fine print so that you know where the penalties are, what the benefits are, what it allows, and where it is that the policy is trying to drive towards, and make sure that you do not hurt yourself in the long run by taking out the loan because they said you can take out a loan, and then you take it all the time such that it now actually depletes the fund that you're trying to put away for your child. And also one other thing is you need to ask questions. The minute you enter into that contract, and that means that you and the insurer are in a relationship for the duration of that particular policy. So make sure that you ask questions. If you don't understand, if you see the escalations and the agent didn't explain that there's actually an annual escalation, you were paying 500 this year, then the next year it's 550 because it's a 10% escalation. So we need to make sure that we understand what the policy is saying and what we're actually getting out of it. Moving on, we're going to talk about the pure investment. So like the name suggests, the pure investment is an investment in simple terms. So what it is, it means that you as the parent now decide that on a monthly basis you're going to put aside X amount of money, and this is going to be purely dedicated towards your child's education. So investing in such or putting away this, you are at liberty to choose where you want the funds to go. So it could be either with an asset manager, it could be with a stock brokerage firm, it could be whatever type of investment that you and your financial advisor will come up with and say, this is where we want to be putting the funds for my child's education, and this is the amount that we are putting away on a monthly basis. So basically how it happens, you now as a parent can decide. You have that flexibility as to when you want to do the contributions. You can decide monthly, annually, quarterly, or however way you can, or as and when you have the funds. You have the control over the underlying asset, right? Because now, as I've said, yourself and the financial advisor can decide where you want this money to go or to be invested, and then the interest as well, because you have that flexibility of choosing where to place the funds. You can find that interest is much higher in most cases from your educator policy, because now you're not now under the umbrella where there are different funds being pulled together to have that policy or fund going. But now you as an individual is now saying, I want to be invested in A fund and B fund and C fund. And then we had said that the contributions, like I've said, along with the timings when you're paying these or making these contributions can vary. Even the amounts that you're making towards this can vary. It's not set in stone, and you can contribute whenever, however much that you want. So the advantages is, one, you have control over the underlying investment. Two, it's flexible in the sense that you can access the funds as and when you want without any penalties. So that's a huge one for people who know that sometimes they might like to dip into that pot. So it's quite flexible. The other advantage is that there are roughly very low costs of transacting, so it becomes cheaper in the long run to actually run such a setup. There's the potential of the high interest, like we've said, because the investments are under your control. And we've also said that you can also use the money for other benefits besides just the education. So you can also pay the fees or tuition, and also pay for educational trips if those may arise. So that flexibility always allows you to cater for other expenses that are still related to the child's education, but not necessarily tuition or book fees and the likes. So the disadvantage of this type of setup is, one, the fact that it's so accessible is also a disadvantage, because if you're not diligent or disciplined enough, you might find yourself dipping into the funds and having now using all the funds that were meant for your child's education and using them from your other needs that may not necessarily be connected to that or related to that education. So that is also a disadvantage. And you might also find that the fact that it is not obligated, some People who lack discipline are actually not going to be disciplined enough to make those monthly contributions or quarterly or annually, however they wish to, and stick to the plan of making those contributions. So you also need, probably as a tip, try to set a debit order, for instance, that goes off your account on a monthly basis, so that you just try to put that regularity in order in terms of making those contributions. So the other disadvantage is market returns. So as much as it's great that when the market is doing good, you can do above inflation returns, you can do 10-15% in returns. Sometimes when the markets are not doing so well, you might find that the market value of the investment declines. But like we've said, do not panic. The proof is in the pudding. The reason why markets fluctuate, they go up and down, is also a benefit to us, because if we are buying at low prices, we can then sell at high prices. But if you're already invested, like we've said, you need to stick it out. Do not panic. There are always lows when it comes to market performance, and there are always highs. So if that investment value does dip, don't panic. Stick it around. It will surely come up at some point in time, and you will be reaping the rewards. And like I've said, another disadvantage could be that as a person, you're not so experienced in terms of making the investment decisions. So you might struggle in choosing whether to be invested in a balanced fund if you are going for unit trusts, or decide whether to be purely in equities and go and buy equities for certain companies off the stock exchange directly, or whether you'll be going through a broker and other stuff like that. So the options are there, but if you're not very sure of which one to go for, it might be an inhibiting factor as well. So the important tips for this one is you need to get assistance in terms of choosing the underlying assets. Another one would also be to have life insurance to cater for your child's education, just in case you do not actually live to contribute throughout the life that you had intended. So if you do pass on, make sure that you have life insurance that can take care of the education expenses in your absence. Like I have said, we will have a part 2 that will be going through the mathematics to help you in trying to assess which one to go for as part 2 to this video. But remember, like we have said, just like anything that has to do with financial planning and financial advice, it's never a one size fits all. So there is someone who's going to like the educator policy, and then someone who's going to like the investment option. This is actually informed by our different backgrounds. You might find that, for instance, I'm self-employed, and I find that the fact that I have the flexibility of contributing towards an investment fund when I do have the funds is much better than having this premium that I have to pay on a monthly basis from an insurance, because there are months where money is tight and I'll find that I'm missing out on the payments. And to make sure that I do not lose out on the contributions that I've already made, the investment option might be better than the life insurance option. So just make sure that you keep your mind open, and if you do need professional help, do not hesitate to contact us and try to see how we can help you with coming up with a bespoke plan.